In chapter 6, we're going to discuss forecasting. So why is this such an important issue? Well, if you produce too much of a product or something that nobody wants to buy, you still have to pay for the materials, labor, and storage associated with those products that you are stuck with. If you produce too little, you're going to incur an opportunity cost. You're going to lose sales and possibly market share, which could have a spillover effect in the future as your competitors are selling more and more product to what were your customers. So we have different ways that we go about forecasting. And the first one has to do with experience, where you kind of get to know the patterns that establish themselves regarding sales, expenses, consumer demand, and so on, just because you're used to doing what you do. And so if you were an editor for a book publisher, you would have read many a manuscript, and you would know what kind of book sells and what kind of book does not sell. Sometimes we have patterns that repeat themselves, and probability analysis can be applied to this. So we have a 7-Eleven that typically loses 1% of its candy inventory to shoplifters. We can probably throw that into a forecast. It's not that we want to lose anything, but the only way to cut that 1% would probably be to frisk everyone walking out the door, and we probably don't want to do that. Next, we have correlation, where certain key variables are correlated with your business. So if you are a real estate agent, every time interest rates go up, your sales are going to tend to go down. And this is highly predictable because the cost of financing gets higher and fewer people are going to be buying homes when the cost of those homes goes up. In this case, the cost being related to the cost of the financing. Similarly, we all know that umbrellas are going to sell better on rainy days than on sunny days, just like snow shovels are going to sell better when the winter weather is bad. So the key to the forecasting process is to try to predict what our income statement and our balance sheet are going to look like for the upcoming planning period. And so the first step in that is to forecast your sales. Sales is the very top line of the income statement, and the income statement is the very first of the major financial statements that we prepare. So we're going to have our marketing people here who are going to know what the sales reps are telling them. Do our customers have high inventories or low inventories? And that'll help us to understand whether they're going to be placing new orders with us. Management, top management might be emphasizing a certain product over others, and that's going to influence what the sales will be. Production is going to address the supply side. If we have demand for a 50% increase in sales, but only supply for a 30% increase, our sales are going to go up by 30%, not 50. We'll have the accountants in there. We're going to coordinate all of these different parties within the firm. And since this is a finance course, we're going to say the finance people are going to be the focus of this, of putting all this together and generate that sales forecast. So if you have a nice predictable business that tends to grow in a roughly linear fashion over time, you could simply extrapolate the historic sales data points and come up with a forecast for the upcoming years. And this would give you an estimate of what you're going to get. In this case, we'd look at our 07 through 014 actual sales and predict our 15 and 16, 2015, 2016 sales figures. Now, sometimes we have reason to believe that our sales will deviate from that extrapolation of the historic line. Here we have a company that is about to introduce a new product, and our marketing people are very optimistic about this, and they think that this new product is going to be a big hit. So we might forecast sales above the simple extrapolation of the historic line. And so if we're going to sell more, we're going to need more resources. And so that turns us to the balance sheet, which includes consideration of what our current assets will need to be in the upcoming period and what our fixed assets will need to be in the upcoming period. So that leads us to the pro forma financial statements. This refers to our prediction of what our income statement and balance sheet is going to look like. And these predictions are predicated upon certain trends and certain relationships between sales and other financial variables. And so the sales forecast that we started with is going to trigger forecasts for other accounting variables that are going to help us as we prepare those pro forma financial statements. So let's take this fictional firm here, and let's say that we are predicting or forecasting sales will go up from $5 million in the current year to $8 million in the coming year or the forecast year. Let's say that our production is already at full capacity. We have 70% of our net income paid out as dividends to our shareholders, and we have certain balance sheet accounts that change spontaneously, that means automatically for the most part, as our sales change. We'll be addressing that specifically coming up here. And so those changes are a constant proportion to sales. And so we're ready to start the pro forma income statement. There's the first line. If your sales are going to go up by 60% and they're currently at 5 million, note that these are all in thousands, so this number right here is 5 million. A 60% increase would be to 8 million. Ending value minus beginning value over beginning value is 60%. So if I multiply 5 million by 1.6, then the projected sales figure is up to 8 million. If the sales are going to increase by 60%, it might be reasonable to assume that the cost of goods sold will also increase by 60%. So we multiply the old or the current cost of goods sold by 1.6 to inflate it or grow it by 60%, and it goes up to 6,613,000. You subtract that from the 8 million, you get 1,387,000. We have interest expense, which we haven't said anything about, so let's just carry that same number forward, assume it's going to be the same in the projected period as for the current period. Subtract that and get our 1,187,000 of earnings before taxes. Multiply that by 0.40, gives us taxes of 475,000, and that leaves us with projected net income of $712,000. Now we're ready to see what that projected balance sheet might be. And so we're going to inflate our current assets by 60%. 2.5 million times 1.6 gives you 4 million. And you will remember that we said that the plant was operating at full capacity, so we're going to have to grow the fixed assets by 60% also. That gives us $8.8 million worth of projected total assets. That's a $3.3 million increase in our projected assets. And so where are the funds going to come from? To answer that question, we have to turn to the right-hand side of the balance sheet. So as we place larger orders with our suppliers, they're going to extend more trade credit to us. Our accounts payable will go up. Again, we'll assume that that's proportionate to the increase in sales. So that $1 million gets increased by 60%. And the same is true with our accrued expenses. That's those accrued wages and taxes that we owe but haven't paid yet. We have our retained earnings, which is a little bit different. We're not simply inflating the retained earnings figure for the current period by 60% because we have more detailed information about what's happening to that number. You'll recall from the review of accounting chapter that the new level of retained earnings is equal to the old retained earnings plus the addition to retained earnings from the income statement, and the addition to retained earnings is your net income times 1 minus your dividend payout ratio. So there's our net income times 1 minus the dividend payout ratio. So if we're paying out 70% of our net income as a dividend, we are retaining 30%, the 1 minus 0.7. And so we have the $712,000 times 0.3 gives us, and we add that to the 1.5 million, it gives us the 1.7 million. And so we simply move forward any other number that we didn't talk about. So long-term debt stays the same, common stock stays the same, notes payable stays the same, and we have 6.6 million as our projected liabilities and equity compared to our 8.8 million projected assets. And this might be the first business class you ever took that is showing you a balance sheet that doesn't balance. Now, if you think that's strange to have a balance sheet that doesn't balance, that is in fact the whole point. And that point is that we are $2.2 million short on the right-hand side of the balance sheet where the funds come from if we hope to finance the entire $8.8 million worth of assets on the left-hand side of the balance sheet. So we need to come up with an additional $2.2 million. $2.2 million is the amount of additional funds needed. So we might go to a bank, sign a promissory note, create notes payable for $2.2 million, or go to an investment banking firm and sell some long-term bonds, or go to an investment banker and sell some new common stock, or some combination of the above, as long as we raise the $2.2 million that we need. Because if we don't raise the $2.2 million that we need, we're not going to get to the $8.8 million asset figure. And if we don't get to the $8.8 million asset figure, we will be unsuccessful in accommodating this projected 60% increase in our sales. So this is very important that we get that money. So these are the steps that we took in order to do our pro forma statements. And so what we want to do then is we want to find out where we might get this $2.2 million. And it's always a good idea if you can walk into the office of your banker and say, I would like to get pre-approved for the upcoming year for a $2.2 million bank loan, or go to the investment banker ahead of time to arrange for the long-term debt or the new common stock issue, because the reason we need the $2.2 million is a good reason. Our sales are going up by 60%. The suppliers of capital are going to be happy to provide this funding to us. If we don't go through the forecasting process, we're going to be turning to the bank or to the investment banker, and we're going to find ourselves running short of cash as the demand for our goods is increasing, our sales demand is increasing, and when you run in at the last minute and say, I need to borrow money, or I need to issue common stock, and let's call it the banker says, why? And you say, I'm not sure, but I just keep running out of cash. That's not a good answer. But when you have a growing firm, and the irony of this whole process is the highly successful, rapidly growing firms are actually more likely to require additional funding than the firms that are stagnant. So that's the essence of Chapter 6, Financial Forecasting and Planning.